Record. There we go. All right. So I feel like it's really important for us to go back and talk about monetary policy, um, particularly because of the week that we've had, financial markets. Guys. It's been a crazy 2 weeks. It's been a 2 week that's been giving for the Fed. The Fed has been getting what they've been wanting. Some of you might ask me basic questions like, what is the Fed? All right. And there's nothing wrong with that. Okay. There's nothing wrong with that. I too, at some point, was just trading based off of technical analysis. Okay? And it got me far enough and it makes other people rich. Jason trades only using technical analysis. So he's doing really, really well. So let's not look down upon it. But you become a really, really powerful trader and a consistently profitable trader. Okay, that's the keyword I'm looking for. When you understand why a particular financial asset is going up or why a particular financial asset is going down, all right? Particularly what we are talking about here is forex. Okay, we're trading currencies, we're trading the dollar, all right? So, in understanding what's going to influence the US dollar to be stronger than or weaker than other currencies on any given day is going to be influenced by the economic data that comes out. All right, let me write that down. So I'm also going to send you these notes. All right, actually, I'm not going to send you these notes. You have the video. All right, so point number one, guys. We're trading the dollar. All right, let's get that. Trading the dollar. And the dollar is driven by the US Federal Reserve. All right, so I'll explain what the Federal Reserve is. The Federal Reserve is a decision-making body that is the equivalent of our South African Reserve Bank. All right, we all countries have reserve banks. Okay, and every reserve bank in every world, even ours, all right, particularly talk about South African Reserve Bank, they only have two priorities. All right, that timer, Researcher Kanyako, whatever his name is, I think it's Researcher. Someone correct me if I'm wrong, but I think our Reserve Bank governor is Researcher.
It is.
It is, right? Yeah. So, guys, that guy's priority as Reserve Bank governor is two things. Okay, two things and two things only, guys. Okay, besides managing, foreign exchange transactions and all that kind of stuff. No, they have two very primary objectives. One of them, right, is to keep inflation at levels that are acceptable. Okay, by inflation, I mean stop prices from running away ridiculously. All right, if bread cost me 10 Rand this year, it can't cost me 50 Rand next year. That's too much inflation. The price of whatever product or service has been inflated to a level where it makes the currency weak. All right, that's why the currency in Zimbabwe is so weak. It's because they have so much inflation. We have the same goods and services, all right, but theirs is so expensive because the currency has been weakened by inflation. So their Reserve Bank did a poor job managing the economy, right? So let me write that down. We're trading the dollar, all right, and the dollar is driven by the Federal Reserve. All right. So what did I say again? The Fed has two mandates. All right. One, keeping inflation at acceptable levels. Number two, is to
Interest.
No. Create an economic
Yeah.
environment that can create maximum employment, right? So immediately you can tell what we're dealing with here. I'm just gonna let's see in the chat. All right, I see your answer there. Oh, can this shit go away? Dang.
In a simple way of saying it, understand if I'm wrong.
I beg your pardon?
I say it's like basically the in between of the interest not going high nor the inflation. So, to bring them neutral to make both balance out,
All right, I'm gonna explain it.
like the governing body.
So I'm gonna explain it nicely here. So
Okay.
already we can tell what our keywords are. All right, we're talking currency. We're talking the controllers of the currency. All right, the US Fed. Let's talk about their mandate. Their priorities are twofold: keeping inflation at acceptable levels. Quote unquote, this is CPI, PCE on the economic calendar, clean, and PPI that we got today. All right, we're still going to do a session on the economic calendar to break down what all that stuff is and what it means. Right. Secondly, to create an economic environment that creates maximum employment. So here they will measure this using NFP and initial jobless claims. All right. This is the basic understanding of where I want you guys to start with this understanding of how to understand these economic points of data. All right, you need to understand what we're trading: the dollar. Who controls it? The Fed. Why do they control it? To keep inflation at acceptable levels and to create an economic environment that can create maximum employment. All right. So now you know what their objectives are. They have two objectives. After understanding their objectives, we now need to look at the current economic standing that they are looking at. So we figured out who's making the decisions. Now we need to look at the same information they are looking at to be making the decisions so that we are reading off of the same page. Tell me if anybody doesn't understand that on a basic level before we even get to the tricky stuff.
Understood.
Everyone else?
Understood.
Aware. All right, so we've understood the characters in the story. We know what they're trying to do, what they're trying to achieve, all right? And we know what they are assessing, what information they are assessing in order to make their decision. Okay, so yeah. Now, in order to make a decision about how, in which direction to steer the economy, all right? Now, guys, the economy can only ever be in two settings, all right? Right. So the economy, guys, is always oscillating between these two modes. All right. It's either in a growth setting or in a recession. All right. Things are either good or they're bad. There's no in between, guys. All right. Which is very, very sad, actually, because it complicates things so much. There's no middle ground. All right. So because of this between the recession and the growth period, all right, It goes through a period of slow growth and a period of high growth. All right. Now, because of these two settings that the economy is in, all right, the, the central banks will always, how can I put this, respond appropriately. When the economy is in a recession and there's a period of slow growth, they need to stimulate the economy. All right. So let me write that down. They need to stimulate it. All right. So by recession, I mean that people don't have jobs. There's very slow and low spending. People aren't buying new homes. People aren't buying new cars. We talk in Zimbabwe, basically. It's been in a recession for decades now, all right? Which is pretty wild if you ask me. So in a period where there is very low growth, the Federal Reserve or South African Reserve Bank, whichever Reserve Bank we're talking, will step in and put in monetary policy measures which will stimulate the economy. So they will do something to get people to spend money. And how do they do that? They lower their interest rates and make getting loans extremely cheap so that people can buy houses, buy cars, start businesses, create maximum employment. Do you understand what I'm trying to say, guys? All right.
Yep.
All right. When an economy is in a recession, they need to stimulate it using low interest rates. When an economy is in a recession, they'll stimulate it using low interest rates, right? People will take out loans, they'll buy cars, they start businesses, they employ people, those people get salaries, those people spend those salaries in stores, and those stores expand and hire more people. You see how this chain of events is getting the economy moving just by getting a simple loan at FNB cheaper. You can manage an entire sequence of events and get the economy moving again. I need you guys to understand that. Does anyone not understand? Everybody understands? We're all on the same page? Because if you don't understand, I need you to ask the question, right? Because if you miss it here, then everything else I'm going to say is just going to confuse you. So I'll ask one more time. Does everybody understand? These are the foundational principles. All right, lovely stuff. I'll take your silence as a yes. Okay, great. So when an economy is in a recession, all right, they'll stimulate it using lower interest rates. Low interest rates are great, all right? It means that instead of paying, so let's just say, I'm going to make an easy example. In a period of low interest rates, I could be paying, arguably, I'm going to use low, simple numbers, 10 Rand a month for my rent on my house, on my bond, instead of paying 12 Rand. Let me actually use real numbers. All right, if I took out a bond on a house worth 1 million Rand, maybe I should be paying like a 10K a month type on that bond, all right, under the lower interest rates. But if the interest rate goes higher, then I'm gonna start paying something like 11, 12, 13 grand, all right? Now, if the government, or not the government, but the Reserve Bank lowers interest rates, you're gonna have an influx of people buying houses at those lower prices, buying cars at those lower prices, taking out business loans at those lower prices, so that their repayments can be affordable and manageable, all right? It's about affecting consumer spending and consumer behavior. You guys understand?
Yes. But it should be the last part again.
Damn, man, I forgot. Shit. I think I'm freestyling all of this stuff, man. You can see I'm writing on the fly. So sometimes if it's past, but I'll remember it again. All right, let's move on. So we already know the period is in, I mean, the economy is in two different settings: a recession, that's a period of slow growth, and a high growth period, um, where there is, maximum employment, booming businesses, high consumer spending. All right. Now, when an economy is in a high growth period, it can cause, okay, with excessive consumer demand, it can lead to inflation. All right. That means the price of things getting more expensive. You guys understand this? I think I wrote it down very, very easily. All right. So when an economy is in a high growth period, right? High growth. With excessive consumer demand, all right, it can lead to inflation, which is bad, guys. We spoke about inflation, right? You remember what inflation is? It is when the price of things get more expensive because everybody wants it at the same time, but it may not be available for everyone at the same time. I go back to the same old example: lockdown with alcohol and cigarettes, right? The price of alcohol and cigarettes went up exponentially when the president decided to lock down the country and ban all the liquor stores from selling liquor. You all remember that, right? The price of alcohol was inflated because there was a lot of demand but very, very low supply. Okay? And that's what happens when everybody has money to spend in an economy. That's what a period of high growth causes. All right. So a recession may last 2 to 3 years, and then the economy may pick up, people spend, then the country does well, but it then gets to a period where they do too well. All right. Over the next 3 to 4 years, that high period of growth may cause inflation of goods and services, which make things more expensive. All right. Now, when things become more expensive, it is bad for the economy because it leads to low consumer spending, turns people off, and that may cause a recession. Right. So, before causing a recession, the the Reserve Bank can step in and fix that situation by taking interest rates up. All right, this can be fixed by taking interest rates up, which will break the cost of loans and reduce the demand from consumers for goods and services. It's as simple as that, guys. All right. And this lack of demand will then bring down the price of those things. Do we understand? That's where we're at. This is beautifully and well written, actually. I'm going to save this and turn it into a book, guys. I'm writing a book, and these are the kind of things that I'm going to be putting in it. All right, these are the kind of, easy to understand, basic breaking down of this monster that we call the financial markets, where we can understand this and maybe trade confidence. Right? So this is where we're at. When an economy is in a high growth period with excessive consumer demand, can lead to inflation. Right? That means the price of things getting more expensive because everyone wants that stuff. Now this can be fixed by taking interest rates up. All right, there's that word again, interest rates. So you can see that interest rates are the tool. All right, you take them up, you take them down. You affect consumer spending, right? Which will affect the cost of loans, all right, raise is a better word, that will raise the cost of loans and reduce the demand from consumers, all right, because things, because because the cost of a loan, all right, under normal conditions, if I wanted to start a business, let's say 3 years ago, it would have cost me to get a 1 million rand loan, maybe I'd have to pay back 15K, 16K a month on that loan to start my business, all right. Now, in the period where we are right now with really high interest rates, that same loan maybe is going to cost me 20K. All right. It might and probably will affect my decision making, right? I'll probably be turned off by paying 20K per month for that loan. I wanted the 15, right? What will I do? I prefer to wait or won't even start that business at all. Now, what does that do? Me not starting that business means I'm not employing those 10 to 15 to 20 people I was going to employ. And me not employing those people means that they're not getting a salary. If they're not getting a salary, they're not spending it at Pick and Pay, at the fuel store, at the grocery store, not buying shoes that are going to movies, right? What does that to the economy? The economy slows down, and that's how you bring down inflation. Do you guys understand? Because I think that I put that down so beautifully. Even the way it's written is really, really well written for you guys to understand. This is the formula, guys. This is our Bible. Every time you get lost, think about this. This is our Bible. Tell me you understand. I'm gonna need responses from everybody.
Yeah, I understand.
Yep, understood.
I understand.
Lovely, 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 guys. So we all on the same page now. We can move forward from this, because this is what you need to understand in order for you to unlock the information that's contained in the articles that I send you every day. The articles that I send you every day, guys, that is the best signals that you will find. I swear to God, guys, it's beyond signals, because it gives you an understanding of what's actually happening, all right? So that even if you don't take the trade, you know what the fuck is going on, so that next time you can execute confidently. Not, it goes beyond technical analysis. So we understand where we are, right? All right. With that being said,
I've got a question.
yeah.
Last week, jobless claims was high, right?
Yes.
But then NFP came in higher.
Yes.
So then I want to understand why.
All right. So,
Yes.
I think it's a disparity between temporary jobs and the fact that some other people work 2 jobs. You know, in America, people will actually work 2 jobs, like for real. And
Yes.
and it's the way that they measure this. In the way they measure this, sometimes they go to, there's 2 surveys. There's surveys that measure the amount. NFP measures. It'll take information from the companies, right? It'll go to each company, guys, how many new people did you hire this month? They get those stats. And then the initial jobless claims will go to every household and measure, not every household, but they'll measure the number of people that file for unemployment insurance benefits, all right? Now, I could have 2 jobs and still lose one and file for unemployment insurance benefits. So I think the disparity is in that number, but I understand the importance of your question. You're trying to ask me, why was there a difference? Because usually those 2 points of data go hand in hand. I get you. I thought they would too. That's why NFP was such a surprise for everybody. We all blew the Namibia. I think 50 of us on the spot all blew our accounts. It was sad to see, bro. The faces just turned blue. You answered. Did I answer that properly?
Well, we couldn't hear you. Were breaking out, so.
So why didn't you say, bro?
Oh, I'm sorry.
Yeah, don't be scared to speak. So what I'm saying is that there's 2 ways that they measure this thing, right? NFP, they go to each company, or well, they don't. physically go to each company. Each company has to report each month, right? How many new people they've hired, right? And you need to understand that in America, the labor market is very different from ours, right? In South Africa, people mostly have one job, right? One job keeps us busy now. But in America, bro, people work 2 to 3 jobs at the same time, bro. 2 to 3 jobs at the same time. So the fact that NFP is higher could be because of some of those temporary jobs that were added. Because initial jobless claims measures the amount of permanent jobs. You can't file for unemployment insurance benefits off of a 3-month job, a temporary job. So I think that NFP, these jobs that we're seeing, guys, they're a result of what am I saying? Fuck, I lost my train of thought. Initial jobless claims, it being higher is a result of a loss of the normal jobs, full-time employees, whereas NFP has been spiked up. This upside surprise we got is because of the temporary jobs and additional jobs that the same person is getting. So I think that the real number on the ground, guys, in the US economy is much worse than you think it is. Because the fact that people work 2 or 3 jobs. That means that the real NFP figure is actually very, very low. And I think that the Fed knows this, which is why September is so attractive in as far as pricing in the probability of getting our first interest rate cut. Do you understand?
Okay, now I do understand.
All right, now let's move into the article. Let's move into today's article. Can you guys still see today's article? I'm still on Word, right? You can see the chart and the... What can you see, actually? Can you only see one thing or 2 things? All right, so let's talk about, what's the date here? 13. Should have typed this wrong. Titled this wrong. So in today's action, guys, reflecting back on yesterday, guys, never mind the headline, let's read these 3 headlines, all right? What we saw from the meeting that came out from the Reserve Bank in the United States yesterday, right? So we've already discussed what the Reserve Bank is, so you already know that. That's why I said that understanding of the basics that I just shared with you is necessary to unlock the information from the bank. So the US Central Bank, guys, decided to leave their interest rate unchanged, all right? The interest rate is sitting at 5.5%. That's what Jerome Powell came out and said yesterday. Jerome Powell is the Fed, is the head of the Reserve Bank of the US, like Lesetja Kganyago is here, all right? So what we got yesterday, guys, primarily, let's start with inflation, all right? Inflation has been on the rise, guys, all right? Let me actually open something where you guys can actually see it properly in real time. Alright guys, we've got 6 minutes left, so I'm going to try and wrap this up quickly. Then we're going to have another session again for the follow-up to this. But let's look at yesterday, alright? Let's look at the CPI year-on-year figure. Alright, so in terms of inflation, guys, the Fed wants inflation, this figure, to be at 2%, alright? Currently, that figure is sitting at 3.3%, alright? Now, that's yesterday's figure that came out. I need you to understand why yesterday's figure is so important, and for us to do that, we need to go back in time, right? Let's look at this year as a whole. Just this year alone. So we're counting from January, yeah, alright? Look at where inflation was sitting. January, it was sitting at 3.4%, right? Then it cooled down 3.1. Then from 3.1, guys, we saw an uptrend. 3.1, 3.2, 3.2, 3.5, 3.5. this is the first fullest print for the year, which was last month. All right. And now when we look at this correlation, right, 15 May, let's look at what happened on the dollar index. Okay, we're looking for 15 May. All right, May the 15th. Okay, I found it. Here we go. Right here. When we got that lower inflation print, look what happened to the dollar. It moved all the way from there and hit that low right there. All right. Again, look what happened. NFP. It's not even NFP. This is yesterday's CPI. All right. Look how the dollar sold off. It came way off right over there. The reason why the dollar is weakening, all right, is because right now we're in a period where interest rates are high at 5.5%. It's the highest in 22 years, guys. All right. The nice thing about high interest rates is that they reward people who have money. All right. Interest rates are bad. High interest rates are bad for people who want to get loans, who don't have money, right? Who want to access credit. But interest rates are good for people who have savings, all right? Because when you open a savings account, what do you look for? You look for a good interest rate. If I'm going to take 100,000 Rand and save it in the bank for 12 months, I'm likely going to get 10,000 Rand profit from that because of the good interest rate, all right? So the higher the interest rate, the better. The more attractive it becomes to keep your money in the bank. And that's what high interest rates do. They stop people who don't have money from spending money, and they stop people who have money from spending money by rewarding them, by paying them a high interest on their money. Now, the reason why the dollar is weakening is because, let's go back to our equation. The dollar is weakening because of that lower CPI print that we got. All right, two of them. I showed you where they are on the chart. It's beautiful how they correlate. The 3.4% that we got last month, 3.3. That is a downtrend. 3.4, 3.3. That's a downtrend. Now, the reason why the dollar sold off yesterday is because of this lower inflation print. What the lower inflation print tells the market is that this high interest rate could potentially be cut in September. All right. So meaning that if you have dollar-based savings accounts, then from September, you will start getting paid less on your investment. And that is drawing demand away from the dollar. So now you're finding people moving their fixed income assets that are in dollars, their savings accounts, from their savings accounts, they're withdrawing it and they are deploying it in other financial assets that can give them a higher return on investment. And those are called risk assets, riskier assets. They're taking the money from the bank, they're buying shares in the NAS 100, all right, the NASDAQ, the companies like Apple, Microsoft, Alphabet, Tesla, Amazon, all right. They're using that money to buy Bitcoin. They're using that money to go to other currencies like the pound, all right. You guys understand that? We've got 1 minute left. I need to know you understand that. And that's why we're seeing the dollar drop off. Can you see the correlation that is there, guys? It is so beautiful. I need to know that you guys see that. Right there. That big drop, that's that first CPI, that 3.4. This drop over here is yesterday's CPI, that 3.3 figure. All right? So the dollar is going to weaken, guys. what we're potentially seeing right now is just a retest. All right, it could just be a retest back up into this level, but the dollar is surely going to weaken. Why? Because the Fed is achieving both of their dual mandates. What did we say their mandates are? Let's go back to our notes real quick. What did NFP say to us? NFP said to us, we got higher jobs last week. All right. What is the first mandate? The first mandate is to create not